Hi, today we're going to calculate the numbers on a buy-to-let rental property. Without calculations, you're guessing. And we all know guesswork is for dummies. My name is Neil Vorster. I'm the author of the book Property Investment 101. There's a link below if you want to grab a copy of the book. Today I'm going to show you how to calculate the numbers that you need to do before you buy any rental property. And to make it really simple for you, I'll provide a downloadable spreadsheet in the links below so that you can do the numbers yourself and take the guesswork out of your next property investment. Let's take all the guesswork out. Please ask questions freely and comment below. I'll endeavor to answer every single question either in the comments below or in another video like this one. If you like this content and you want to see more of our videos, please subscribe below and hit that bell to be notified when we upload our next video. We're going to look at the costs involved in buying a rental property. We're going to look at mortgage financing. We're going to look at the monthly rental cash flow. And we're going to look at the 3 different types of return on investment that you have to calculate before you can consider an investment property. These are the calculations I do before I buy any rental property. So let's go to the whiteboard and I'll show you how to do them. In this example, we're looking at the purchase of a $300,000 apartment. I'm using an American example here, but the principles that we're going to discuss here apply throughout the world, whether you're in yen, pounds, or dollars. So when you buy a property and it is transferred into your name, that process is called closing, and it involves various appraisal fees and attorney's costs. And with an apartment of $300,000, you'd expect those closing costs to be about $5,000. And then in this example, we're going to put on a down payment of 10%, which is 30,000 US. And then with every single property I've ever bought, there are always some repairs. There's always something that you missed, or when you buy it, you think that's not a big problem, I'll fix it later. Include that in your costs. So I'm going to put an estimation of $2,000 here to do some minor repairs. And that gives me a total of $37,000. Now this is a very important number, and you'll see why when we come back to working out the return on investment. But this is your investment. You didn't invest 300,000 US, you invested 37,000 US dollars. So let's go across to the cash flow now. Just look at your monthly cash flow, and then I'm going to do monthly cash flows and then come back to return on investment. So in this example, we're expecting for an apartment of about $300,000 for your rental to be of the order of about $3,000. And I'm assuming in your lease agreement, you arrange that the tenant pays for all the utilities. Now, utilities are gas, garbage, electricity, water, all those kind of costs. So in this lease, the tenant is paying $3,000 plus utilities. So now let's look at his expenses. Now his expenses here, first one is property tax. Everybody pays tax. Property tax you can expect to be about $310 in this example. Now every time you buy a property, you really got to do your homework and do this. Find out what all these numbers are. This is all part of your due diligence. But I've done the homework already for this example, and those are the numbers I'm going to use. So the next thing is building insurance. You can expect that to be about $150. The next thing is homeowners association. And the homeowners association is a collective of all the owners of the properties in that complex. This is an apartment, and there are a whole lot of combined costs. And in an apartment of $300,000, you can expect your homeowners association costs to be of the order of about $500 a month. The next thing is your mortgage, and for a mortgage of $270,000 US dollars at current interest rates, you can expect it to be, in my example, I've used $1,320 per month. The next thing is PMI. PMI is your private mortgage insurance. If your down payment is less than 20%, the bank's going to require that you insure the mortgage to reduce their risk. So the PMI in this case would be about 140, and this varies. These numbers all vary a little bit, but these are indicative. The next cost, bear in mind, these are monthly expenses. Your next monthly expense is utilities, but because our lease agreement says that the tenant's paying for all the utilities, that's zero. And then the last expense we come to is property management, and you can expect about 10% to be indicative of what most property managers would charge you, most agents would charge you. And this is an expense that enables you to sleep well at night. It enables you to invest in property without having to have 30 years of property experience before you can manage a tenant, manage credit control, all those sort of things. So I believe it's money very well spent, and 10% of your rental is $300 per month, and that your total expenses come to $2,720. That your monthly expenses here are $2,720, but your income is $3,000. So the difference between your income and your expense is your net cash flow. In this case, it's $280 a month. $280 a month is what you can expect. Is that we call this positive cash flow because your income is greater than your expenses. So now that we've worked out our monthly cash flow, now we've got to move across to we know what our investment is, we know the purchase price is, we know what the monthly costs are, and now we can start going to get onto the exciting stuff and working out your return on investment. So the first thing is we need to take this monthly cash flow and multiply it by 12. And that gives you your annual cash flow. So let's move across here to your annual cash flow. Now your annual cash flow here, 12 times 280 is 3360. I'm not a mental math genius, I wrote it down and I worked it out earlier. So your cash flow annual is $3,360. And now the next thing is your capital growth. How much did this property grow in a year? Bearing in mind we're looking at first year return on investment. So in America, the average is about 5%. If you go back the last 20 years or so, it's had the capital growth, the average capital growth of properties, of residential properties, it's been up at 10%, it's been below -8% and so on, but on average over the last 20 years, it's been about 5%. So I've used 5% in this example, and bearing in mind the minor location, the location of your property also affects your cash flow, your capital growth. So I'm going to use 5% here as an example. So, but now this is where it starts getting very exciting because we're looking at the return on investment. My investment is 37,000 US, but my purchase price is 300,000. So let's assume I bought this at the right value. So after 1 year, this has grown by, let's say 5%. 5% capital growth, 5% of 300,000 is 15,000. So your capital growth in a year is going to be 15,000. So that what that's saying to me is that in a year's time, this property will be worth $315,000. Okay, now the fun stuff. I did all of this so we can get to this. This is really what it's all about. Your return on investment. You can equate it with interest. You know, everybody might put money in the bank and get interest on their savings. That interest number is return on investment. It's return on your cash. So let's see what you can expect on a property. So the first one is cash on cash. Now this one is we look at cash, that number there, annual cash, divided by the investment cash. So it's 3,300 divided by 37,000, and you express as a percentage. That comes to 9.08%. The next thing is your capital growth, your capital return on investment. So with your capital growth, you came to 15,000 US is your capital growth in the first year. And look at this now. We are taking 15,000 and we divide it by what you invested. And you start seeing why I really get excited about property. So you don't say 15,000 divided by your purchase price. You would do that calculation if you paid cash for the property, but you didn't. You bought it with other people's money, of course. So your capital return on investment is actually 15,000 divided by 37,000, which comes to 40.54%. So you get your capital growth is 40%, 40.54%. Your cash on cash is 9.08%. And then when you combine the two, you're saying, what is my total cash and my total capital growth for the year? You add the two of those and you get your 18,360, and you divide that by the 37,000 and you get to 49.62%. So it's those two numbers the total of these two divided by your total cost, that gives you your combined return on investment. And then by some magic of mathematics, if you take those two numbers and add them, you get to the same number. So this is basically how you get to, this is how you do the numbers on a property. Every single property I buy, I do all of these numbers. If you use our downloadable spreadsheet that you can find below, and you follow the process, you'll see it's not that complicated at all. Let me show you. I'll just run you through it again. Firstly, you have to establish is your price. And then you look at mortgage financing, which in this case is 10%, which is $30,000, which means you have a mortgage of $270,000. You find out what that mortgage, your monthly mortgage payment is, and you insert it in there. There's your mortgage payment. And then you do your closing costs. And then you remember this number. This is your vital number. This $37,000. That's your investment. That's your purchase price. Never confuse the two, because we're using other people's money. Then we want to come and see what your return on investment is. So the way to do that is you have to see what your monthly cash flow is. So let's look at your monthly cash flow. Your monthly cash flow, you've got rental money coming in, $3,000, less your expenses, gives you a monthly either positive or negative cash flow. You multiply that by 12. You have to get to annual numbers because we're looking at your annual return on investment here. So your cash flow annual, 280,000 times 12 is 3,360 is your annual cash flow, and it's positive. And then you've got to look at your capital growth, and that's based on what you project the property is going to grow in value. Bearing in mind we're looking at that number multiplying by 5% or increasing by 5%, not that number. And once you know your annual cash flow in and your annual capital growth, then we can get onto the exciting stuff. And the exciting stuff is working at your cash on cash, return on investment. In other words, if I put that 37,000, do I put it into this property or do I put it into a bank? If I put it in a bank, I'm going to get 3 or 4%. If I put it in the property, I'm going to get 9%. And then you get your capital growth, and your capital return on investment is based on the growth of the whole property divided by your investment, not divided by that number. This is the mistake many people make. And that gives you this whopping number of 40.54%. And you add those two together, that's your combined return on investment. And that, ladies and gentlemen, is why I love property. If these numbers don't excite you, then I don't know what will. So if you found this video informative, please like it and share it. And so make sure you subscribe to our channel so you can see our next video. And I look forward to seeing you in the next video. And please comment and ask questions below.